Hey, Chris, it's great to have you back. It's been a little while since we've had a conversation, but I figured it was far past time, probably. And certainly, we've had a lot of disruptions and dislocations in the marketplace. I mean, we've had them all along. We've had them going back to before COVID. We had dislocations there. There's always dislocations of different levels and different frequencies and different depths. But I think all things considered, we're in a pretty volatile period right now. I would just have to say, would you agree? Just in general, pretty volatile right now.
Definitely, yeah, Dave. It's good to be with you and with the group. Definitely volatile. So what's today? April
17.
17th. So we're sitting here 2 weeks after Liberation
Yes,
Day,
I was going to ask you,
and
how liberated are you?
right. What is the saying? We've been liberated by all of the gains in the stock market,
Well,
right?
that's one way to look at it.
Yes, yes. Liberated from having to pay capital gains tax, not because they reduced the rate, but because
Right.
we don't have any more gains.
There you go. There you go.
Yeah,
Well, why don't we? Well, yeah. So why don't we start this way? I've got a zillion questions to ask you, and we won't get to all of them. But rather than me jumping right into questions, I think it's probably more appropriate that I just let you take the floor for as many minutes as you want to, and just kind of lay out from a higher level view what you're looking at from your vantage point, because what you're looking at is really. I mean, obviously, you go to a very micro level, but as an investor, as more of a passive investor today, which is a lot of my tribe, we want to be in the alternative space. Real estate's always been a big part of that. We'd like to kind of hear through your eyes because you have to look at the same things, just at obviously a more depth level. What do you got your eyes on? What are you looking at? And then we'll just go from there.
yeah. Okay. So my core business is arranging financing. So whether that's acquisition financing or refinancing, right? Historically, 50% of my business has been refinances and 50% of my business is acquisition.
Okay.
Let's start with refinancing. There is very little elective refinancing happening, right? So the only situations that where refinancings are happening is where there's some type of event,
Yeah.
right? Whether that's a maturity, that's a covenant breach, that's equity needing to be repaid, etc. Right? So inherently in those events, right? It's probably not going perfectly, right? So we're usually solving problems,
Right.
right? Because if it was going great, well, they probably would extend or they would, what else, sell or something, right?
So this is not a voluntary. Gee, it would be nice if we could. And I mean, let's just put the obvious elephant in the room here. Um, Interest rates are substantially higher than they were 4 years ago. When oftentimes it made sense to take various terms and valuations were going up. So whether you're refinancing, selling out to another party, um, things were moving. But as you said, now it's not so much voluntary; it's an involuntary event, and that's probably not a fun event. But you're having to solve that. So yeah, I'd like to hear more about that. What's that
Sure.
looking like, and how?
So
And yeah,
yes, I call them elective refinance. And nobody's electing to refinance because I could get lower rate, more IO, higher proceeds. So mostly we're solving problems in that scenario, and the way we solve them is very dependent on property type. You know, there are some problems that are like very difficult to solve right now, specifically office. Right, there's just not a lot of liquidity in office. Um, and some other subtypes, sub property types that experience some fundamental challenges. Storage had a lot of supply. New Class A multi had a lot of supply get delivered. So there's some challenges inherently, but the broad scope is there is still liquidity out there. It's not as cheap as you might have wanted it to be or been accustomed to for the last few years. So we're doing some cash neutral refinances, some cash in refinances, some cash in with new equity,
so so what?
restructuring the equity.
So what? So let's. I think we probably should define that a little bit for people. So let's just explain what is a cash in, and that's kind of a new nomenclature.
Sure.
It's not new to you, but I mean it's new to a lot of people. So explain cash in, cash neutral.
Sure. So say you bought a property in 2021 and you paid a pretty full price, right? You've come in, you've created some value, but you haven't been able to create enough value to offset the 4% cap rate that you paid, right? And at the time you purchased the property, you had a pretty full loan, right? Maybe it was 75% of the purchase price plus 100% of the capex. So we're now 3 years into this, plus 2 extensions into this, and your lender kind of says, David, it's been great, but it's time. It's time for us to get paid back.
I've been paying the note. I'm current on the note. I'm making it.
Yep.
But the lender's taking a different look. And why would a lender start to feel that way? If I've been a good payer up to date, why would they start looking a little bit askance and saying it's time to do something? What are they
Well,
trying to do?
you've probably run out of time in
Okay.
your loan documents. Typical loan is 3 year. Typical bridge loan was 3 year deal with 2 1 year extensions. So we got through our 3 years. We extended once,
Hmm.
extended another time, right? And now it's time, right? So instead of they were able to kind of work within the documents, but now it would require a full-on modification. And the lender is sitting there and they're saying, well, I get that your equity might be a little bit impaired, but my first mortgage is fine, right?
Hmm.
If you sold it today, I'm getting repaid in full. So they're coming from a little bit more of a position of strength today. They're kind of saying like, it's time, pay us off, right? So that gets to the cash in, which means, your property's performing. We could refinance it and we could put a new loan in place. But given the constraints of interest rates and debt service coverage ratio required, we can't get enough loan proceeds to fully pay off the outstanding first mortgage. So it would require on the closing statement the borrower to bring fresh equity to right size that loan.
Going to have to write a check to put into the basket to make the lender to make the numbers, the ratios,
Yep.
fit in the underwriting box of the lender, which 4 years ago was fine, but today with the higher interest rates and whatever else could be impairing to some degree the NOI. We don't know. It could be okay. It could be whatever.
Mm-hmm.
I mean, property taxes, insurance. I mean, there's a
A lot of things.
lot of friction that could also be potentially impairing the margin on the operating cash flows, and the lender's going to look at all that. So and the rate that they wrote at 4 years ago is less than what today. So they'd also like to, if it makes sense, they'd go ahead and rewrite the loan, but they want some fresh equity in, and they'd like to have the higher interest rate to make it more nominal for the current state of the
That's
market.
right. You think the same thing is like with a loan with a community bank where there's a covenant in place, right? So they made a loan, a few years ago as a 5 year loan at 4%,
Mm-hmm.
right? Well, fast forward to the time when the loan is going to renew and the rate would then go to 7%. Well, if the cash flow hasn't increased sufficiently, you would need to pay down the loan to stay within those covenants. Same situation
Right,
without fully recapitalizing the loan. You're just paying it down.
right. For some borrowers, that may not be really on the table. In other words, maybe out of capital. So in some cases, they go back to their investor pool and say, "Hey, we got a situation here." I mean, that happens, and they go back to their investors and try to get more equity from their investors at some place in the capital stack. And I guess sometimes they're successful, sometimes they're not. Right? You see it probably both ways.
Yeah, that's right. So, I mean, handful of options, right? First option, easiest option, probably in the operating agreement says we go back and there's a capital call, right? Everybody needs to put up their pro rata share of whatever the cash in required. You know, this specific scenario where you're writing a check into the deal is a little bit more tolerable than to say, hey, we can't cover our interest expense, so we need to feed it for that, right?
Mm-hmm. You're right.
If you're writing a check and you know that it's good, that as soon as this check goes in and we pay down the loan, there will then be cash flow, it's a little bit easier to stomach that check,
I
right?
agree. Yep.
That said, a lot of these investors are in a bunch of deals that are not going great, right? So you may have a great story, a great reason, a great outcome. It's still hard to get new money in the door, right?
Yeah.
So capital call. Second option would be a member loan, right? GP strokes a check. But to your point, like if you have several properties in the same position, right? Do you have the liquidity to handle all of those? Who knows? You could bring in new money, right? You could bring in as a loan, or you could bring in new money as equity, dilute yourself, dilute others. So there's options, right? There's options. None of them are perfect.
So going back to the top of our conversation, you start out by talking about, historically in your business, about 50% went to new acquisitions, 50% to refinance. You said the refinance has dropped significantly outside of these special situations we're talking about right now. So we're kind of going down that rabbit hole a little bit. And what percentage of your entire portfolio today, what's the percentage between acquisition and these refinance cases? Approximately, just roughly. I'm just
Yeah,
curious.
I haven't run it. I haven't run it, but it's probably similar. 40, 60, 40, 40, 60. Yeah, I wouldn't say that it's changed too
Right.
much.
Yeah, because there's still a lot of money out there, and something's got to happen. I mean,
That's right. We have a lot of clients that are very active, and because it ebbs and flows. You got clients with big portfolios that you're constantly refinancing deals from, but they're not that active, right? And then you have clients that are active and that they always want to be buying properties, right? So it ebbs and flows. There's still a great opportunity to buy new properties if you're looking for them, if you're well capitalized, if you're well positioned to take advantage of them. So we're still seeing a lot of acquisitions, but I will tell you the volume of transactions is much less, but the quality of opportunity, there are better opportunities when they do come.
okay, all right. Let's also make one more comparison, and I think this maybe helps people also. When people look at we mentioned, people losing a lot of their wealth in the equity markets, stock market, for example, overall in the last number of weeks, actually going back to like February. So there's been obviously a big change there. And what we hear is that, kind of back to what you do, is in the equity market, it's the bond market you want to pay attention to, because the bond market's where the liquidity is. And if the bond market tightens up, which is analogous to interest rates, where interest rates are going, then that's going to affect the equities, your stock market, your companies there, and affects them the same way it does in real estate. So a viable comparison, you're in you're in the also the credit space, liquidity space in real estate, which is we call it like the capital markets, right? That's the right term, capital markets, and the financial markets is the bond market. So is that a fair comparison? And you're sitting right there in the middle of the liquidity market. What drives the real estate equity market? Is that fair?
Yeah, that's fair to say. Think of it this way: a mortgage rate has two components. The first is an index, and the second is a spread. So the index, depending on what type of loan you're doing, construction loan is on the short end, a permanent loan is on the long end, and they're all priced based off treasuries for the most part, right? SOFR, like overnight borrowing rate, 30, 1 month term SOFR. A 5-year loan might be priced over the 5-year treasury. A 10-year loan might be priced over the 10-year treasury, right? So that market is, obviously depends on or dictates mortgage rates. The second is the spread, and the spread is a function of risk, right? So the more risk that's perceived in the markets in general, the wider those spreads are. It's interesting though, because we sit here today with a 10-year treasury where in the around 4.33,
Yeah.
which is exactly where we've been for the last 60 days. It just seems so volatile, right? And SOFR has been at 4.30 for the last 6 months. So really no real changes in the indexes. When there was a lot of volatility the last couple of weeks, we have seen spreads come out a bit, which is to be expected.
Yeah, we saw the 10-year do a pretty big jump from like under 4 to about almost 4.5, or maybe hit 4.5 for a day, and then and so that it's the rapid rise. I mean, 60 basis points is 60 basis points. That's not something to not, that you wouldn't, you don't just sneeze over that and say nothing to do about it. But isn't it the rate of change that disrupts the markets more than the amount? Is that fair? Or in other words, I guess what I'm trying to ask you, Chris, is certainly we can see the bond market, say, take the 10-year or 5-year, pick one, and if it inches up or inches down over a period of maybe a few months, but when it happens over a period of maybe a few days, is that cause more potential uncertainty that causes markets to like even short-term freeze up a little bit, or does it seem to matter?
Yeah, it's difficult to make decisions when it's moving so
Yeah.
quickly, right? So you'll just see people pause, right? Is really what happen. Like you may be in a position to lock a rate, but you see all this volatility, and you just you don't know what the right thing to do, so you just sit on it, right?
Mm-hmm.
The level of rates is not as important as the consistency of rates, because if you told any of us, right, hey, you're going to have a 4.5% treasury for the next 5 years, we could all operate in that environment, right? It's the uncertainty and the volatility that makes it hard to run and plan your business.
And we're not going to go down a political side on this. Is we just have to say what it is. But I think that bodes back into what's happened since Liberation Day. Is we've got this new grenade that's been tossed into the entire global trade. What used to be some level of equilibrium. I mean, it's always changed a little bit, but once again, this grenade's been thrown out and caused serious uncertainty, serious unknowns, where it seems like it's really hard for anybody, whether you're an investor, operator, business owner, to try to figure out, well, what I was thinking about making this move. I was thinking about, acquiring, expanding, or I was thinking about investing some money over here. And now it's like, whoa, I'm not so sure, because how does this uncertainty globally with all the different dislocations, but particularly with the tariffs being such an unknown right now, such a major shift over, an imperfect world, but at least a world that had some level of known, here's how it works. What's your global sense of where this stands, and how long does uncertainty, in your opinion, I know we don't know, how long does uncertainty going to prevail? When outside of a miracle happening, all of a sudden, the negotiations overall in the next 2 weeks calm everything down, and I don't know, U.S. and China somehow figure something out, and that could happen, I guess. I don't know that it will. But outside of that, if this whole trade imbalance thing carries on for months, what do you think that does to our overall markets? And then go back to what we're talking about today.
Yeah, I'm not smart enough to know what they're thinking with the tariffs.
That's why I brought you on here today. I thought we were going to get to that.
I don't know, but I'll tell you where it comes into play in our world.
Mm-hmm.
And that is, you have inflation that's still slightly elevated, right? It's kind of on the right track, but it's not quite where they want it to be, right? So you bring into play these tariffs, and that's got twofold issues. The first is they're likely inflationary.
Mm-hmm.
So you already have high inflation, and you have the potential to create more inflation, which really ties the Fed's hands, right? They want to cut rates, but they really can't, because inflation is still a little too high, and they're seeing potentially could get worse, right? The second is it likely slows growth,
Mm-hmm.
right? Likely. So if you have a slowdown in growth, that's where it starts to impact jobs and wages, right? So you have inflation that's not at a level where you need it to be, and you start to have some concerns on the job front, and now the Fed's in a really tough spot, right? You throw into that mix, right, tax policy, right, where you want, you operating at a big budget deficit, so you got to issue more paper, with no real plans on how you're gonna pay for it, and you got $9 trillion, I think, rolling in the next 12 months.
Right.
So it's a tough spot. It's a tough spot.
Yeah, it is. What's changed more, more back to the relationships that you do have and do know. What's changed in the last 6 or 12 months between borrowers and lenders relationships? It seemed like for since rates started the rapid rise. What was that? I lose track now. Is that 22, 23 when
End of 22.
yeah, in 22? So when rates started going up, um, what I sensed, and I think through some conversations with you, is that banks, institutions have not been aggressive about maybe what they did some more in 2008, which was like default. We're taking the property. It seems like the trend has been more like institutions. We don't really want the property. We'd rather work something out, extend, do something we can within covenants or whatever their requirements are to try to let the operator get through this. We don't really want to be in that game. Is that general statement fair for where we've been, and is that changing at all?
Yeah, but I think that's definitely where we've been, right?
Mm-hmm.
A lot of the problem properties were purchased in 2021
Yeah.
and the first half of 2022. And though the problem properties had short-term loans on them. We can recall that if we paid the same price in 2021 or 2022, but we borrowed the money at 3% fixed for 10 years, we wouldn't have any problems, right? Except for maybe office, but you still would be in a better spot, right? So the problem areas are on these relatively recent purchases with short duration loans. Um, so, but at this point, you're 3-4 years into those properties, right, or into those loans, and the lender has been working with you. But if we couldn't, and a lot of these people were kicking the can down the road, thinking that interest rates were going to go down and save them, right? This most recent batch of spiking interest rates and then even leveling out here in like the low to mid fours,
Mm-hmm.
like there's kind of been a sentiment shift that like interest rates aren't going to come drop and save you, right? So it's time to it's time to meet the market and transact.
Okay, so if I'm reading you correctly, then there may become more distress in certain segments of the commercial marketplace that maybe where it hasn't shown up so much in certain sectors. Again, notwithstanding office, but the others we could see for a period of time while some of this gets worked through the pipeline. I guess is the way I look at it. You can have kind of a backlog. That's been sitting there. And all of a sudden, does it start to move more quickly? Where certain loans are, the banks are saying, okay, no more, and is that going to start to happen? Do you
Yeah,
think?
I think that's exactly the case, right?
Okay.
Because in that scenario where you have to refinance your property, but you can't get enough proceeds to pay off the first
Mm-hmm.
mortgage. If you can't call capital, you need to sell the property,
Yep.
right? And it's finally getting to the point where some of these folks are like accepting that that's reality, and are trying to meet the market. So yes, I would say transaction inquiries and listings have definitely picked up because of that.
Okay. Great. Then let's follow that line, and let me ask you then. We know that in any marketplace, if you're well connected or you're out on the front and connected, that there are always opportunities, but maybe there's fewer and far between um, in dislocations. What should we, as like more passive investors that like to put our capital with good operators in either equity or debt positions? What might we look for? What signals could you give us? This is going to be broad, not, but
Yeah.
what signals will we look for, particularly based on our conversation here a minute ago about the fact there's probably more properties are going to work and loans that work themselves through the default and being taken back by the banks and then put back
Yeah.
onto the market. What should we kind of look for, and what kind of historically what kind of time do we have to maybe, I guess, dollar cost average back in on the down and on the back up, because there's never a perfect time
Hmm.
for either side, right? So what kind of general things would we
Yeah.
look for?
So good question. Two main things. the first is the overarching theme is quality. So that's quality on the sponsorship side, right? Your jockey, your GP, your manager is experienced, capable, strong, right? So that's the first way to de-risk any deal. And then you have quality on the underlying real estate side. So better, bigger markets, newer assets, right? Those are kind of the ways to key ways to de-risk your deal. And then the third is, I guess you could call it quality on your loan assumptions, right? So longer loans, lower interest rates, right? Those sorts of things de-risk your deal. Does that answer your question?
Yeah. What about? And again, this is be through your lens too, because you make all kinds of loans, helping operators, borrowers with acquisitions of all kinds. I assume still today. So, based on looking at the quality of the loan, fixed rate, longer duration, would you as an investor, and you can just speak about me, you don't have to talk about yourself, you just say, you just look at me being passive but also more conservative. Is there a place today where I would find an opportunity that would be underwritten, underwritten by someone like you who knows what you're doing, where it is more of a new development, redevelopment, where someone will go back and have to take a variable rate loan for that 3+ 2-year extensions to get to stabilization? Is that a game that's still viable today? I know in certain areas it probably is, but is it few and far between? Like a number of years ago, it was like game on, right? Let's go. What do you sense there? What are you guys doing with that?
Definitely. So virtually all new construction is variable rate mortgages, right? They're floater. We call them floaters, right? SOFR plus some spread. Because you're drawing on the construction facility as it gets built. There's really no real way to navigate that. I mean, you can by doing some forward starting swaps and hedging a little bit here and there. That's a way to mitigate some of that risk. As far as value add deals goes, definitely the preference has been to do fixed rate versus floating rate. But in this environment, as of late, we have actually seen people go back to the floating rate loans because they kind of think we're at a higher level and they may be able to capture the downside if there is cutting.
We're at a higher level for what?
For Fed funds. So SOFR's at 4.30, right? So if you foresee them going to 2%, then you would capture that 2% drop over the life of your loan, right? So we are seeing a little bit more of that. What solves all of this, though, David, is equity, right? If you just de-risk your loan and you do a 50% LTC or LTV loan, even if it's a floating rate, once you execute your business plan, you likely don't need to bring cash to refinance it because you've already de-levered it.
Yes.
So equity is the solution.
All right, so that helps. So it sounds like, if I liked a sponsor, an operator, had a good track record, but they're bringing me an opportunity to look at something that is a development, they are going to be using floating rate. What I might look for, outside of the sponsor having a good track record, is that the amount of debt that they're taking on is 50% or less, which means they're going to have to be good enough to raise that kind of equity because of their track record and reputation. And if they can do that, then I can stress test, at different interest rates, right, and see that, okay, even if rates don't come down, where are we going to be in that 3 or 4 or 5 year period? That's probably what you have to do too, right? If you're going to make that loan, you're doing the same thing.
That's exactly right. I mean, even in today's world, even if you wanted a ton of the most leverage you could get on a typical construction loan, like with a traditional lender, not kind of like a debt fund, is in that 65% loan to cost range. Because when they stress the stabilize exit cash flows, you need to be able to refinance them out. And at today's rates, maybe with a little bit of stress, that's all you could qualify for, right? So somewhere in that range would be normal. Less than that would be more conservative. Look, but the other thing to think about, though, is the reason these guys are making these development bets today is because what you're seeing, because the fundamentals are looking really good for a couple years out from now. There has been a lot of deliveries. There still are a few deliveries, but there are virtually no starts, and there haven't really been any starts over the last 6 months.
Now,
So
is that across a number of asset classes, categories, or would you pinpoint some where you could say definitely not a lot of delivery coming on?
yeah, there's no office delivery, right? In fact, there should be demolition of office inventory.
Exactly.
There's been industrial continuously. Retail never really, really has a ton of new build, right? It's there's a saying that we're not over retailed, we're under demolished because there's too much of it.
Okay.
But I'm really focused on apartments, right?
Okay.
So there had been a ton of supply delivered over the last several years, but there's just really not a lot of new starts happening. So if you can power through and you can make your deal work today, and you deliver in 24, 36 months, it's likely that you will be rewarded because you will be delivering into an environment with very little new supply, right? There's always going to be supply and inventory, but you would be the new supply.
Okay, that's helpful. And something you said a minute ago, we're talking about credit spreads, and SOFR, as you said, has been pretty static for 6 months. The spread has the spread also SOFR plus, has that also remained pretty static as well?
Good question. We actually saw some tightening of spreads, towards the end of last year. Just as the market got a little bit more competitive and it started to heat up a little bit. But since there's been some volatility, we've seen spreads blow out. So you're probably net in about the same place as you were 6 months ago, but a little bit more spread widening over the last couple of weeks.
And that's something that any of us can use as one marker to kind of understand what the market is saying about risk, right?
Yeah, exactly. I mean, if you follow non-investment grade, like junk bond credit spreads, like you're definitely seeing them blow up.
Yes. Yeah. Okay. Very good. Chris, give us a little bit of where private credit, shadow banking fits in today, and maybe tiny bit of history as to how that shadow banking market has exacerbated, has grown, since coming out of 2008, 2010, Dodd-Frank, regulations that were trying to prevent that ever happening again, and yet there's always workarounds. What's happening there, and is there potential collateral risk out there that really is not regulated, and is there something that could trip a trigger somewhere in the credit capital markets that we should at least have some awareness about?
So I'm certainly not a private credit expert, but I'll give you an example of how it could, where I think it could come into play. So say I raise a debt fund, and I'm going to make commercial real estate loans.
Right.
So you want to buy a property, you come to the debt fund, I say, I'm going to lend you 80% of your of your purchase price plus some of your some of your capex, and I'm willing to do 80+% because I'm getting paid for that risk, right? I'm charging you a little bit higher rate, right? So what I'm going to do is I'm going to close on your loan, but then I'm going to go to my bank and I'm going to lay off 55, 60% of my risk at much cheaper rates, right? And then I'm going to keep the top tranche as as my piece. I'm going to service the loan, and we're going to stay involved, right? but we're making, much bigger returns on our piece, right?
Because we're using leverage.
Correct.
Yeah.
Right. Now, where does that come into play? If your line starts saying we need to be repaid,
The
right?
bank that we went to drop off 55%, because those terms are what do those terms look like? They're not
Yeah, I
fixed
mean
rate
they're
for 10 years.
right. Yeah, they're floating rate too. That's exactly
Right.
right. So if they start having problems somewhere else and they need to get their money back, they go to the good stuff, right? Go to my loan's performing,
Yep.
right? But they need your line repaid, right? Now you start creating problems, right? So I think that's probably where it would start. And then of course you probably have guys, debt funds like me, making risky loans, right? And if some of those don't pan out, right, then investors lose money.
Yeah. Yeah. Okay. All right. Helpful. All right. Just a couple more, Chris. I really appreciate it. This is really helpful. What what are some common mistakes or blind spots that you see passive investors make? Could you name any that they're just right out there in front that we should probably be more aware of?
Sure. The okay, the okay, yes, many,
Yeah, I was gonna
many
say
of
you're
them.
just trying to figure out which ones, right?
Yeah, many of them. Um, so first thing to understand is like a lot of you're really not going to have any say, right? So you're making you're making an investment and you're trusting the sponsor to execute on the business plan, right? So that's the first thing is like that you really don't have much of a stick. You're betting on the sponsor. So that's the first. Just vetting the sponsor is the most important is the most important thing. The second is um, understanding the waterfall and like what sort of preferred returns you're going to get paid. Are they current? Do they need to be paid? What happens if they're not paid? Those sorts of things. Understanding the actual economics. Um, and then fourth is like making sure that the risks and the I guess making sure the rewards and the risks are aligned,
Mhm.
right? If somebody's coming in and they're taking a big acquisition fee or sponsorship fee or whatever it is, and their co-invest is minimal or you know non-existent, then are the risks and rewards really aligned, right? So those are the key things.
Yeah, very good, very good. Well, Chris, you've handled a lot of what my questions were today. Really, 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 really helpful, and I'd love to have you back again. In due time to see what's transpired. But interesting times for sure.
We'll be here. There'll be ups and downs. Anytime you want to talk, run through a situation, we can do to help you or any of your folks. Like we're here.
Great.
So we appreciate you. Appreciate you having us on. Love what you're doing for the community. So any way we can be a resource, we're happy to.
Thanks so much, Chris.
Thanks, David.